much. The stock market is certainly reacting to the threat. Down around the world, in part, investors are responding to this threat, the debate in Washington. In part, though, there are some disappointing economic statistics the market is digesting as well. Here to talk about all of it is Paul Hickey. He is the co-founder of Bespoke Investment Group, sitting right beside me here in the newsroom. Paul, thanks for coming in.
Thanks for having me.
How much of yesterday's sell-off is worry that we're going to hit this August 2nd deadline without a resolution, and how much is concern that we're heading for a double-dip recession?
I wouldn't want to put an exact percentage on either one, but I think the weak economic data we had yesterday is having just as much of an impact on the markets as the debt ceiling.
Because arguably we didn't see a sell-off in stocks anyway on Monday or Tuesday after we missed that self-imposed deadline on Sunday, which is what I thought coming in Monday morning we were going to see. But that yesterday durable goods number, that did seem to rattle the markets.
That got things started off on a low note anyway. And if you look at the markets over the last several weeks, we've been seeing this notable pattern where the markets open strong, and by the end of the day, nobody wants to own stocks. And the end of the last hour of the day has been down more often than not. The S&P would be over 4% higher this year if it weren't for the last hour of the day. And that's mostly from the last few weeks.
How much are you watching some of the other products out there to gauge what's going to happen in the stock market? And by that, I mean bonds, gold, the dollar. There's a lot more movement there in some ways than in the equity markets.
Right. Well, in the bond market, the reaction has been pretty sanguine. So, that's not showing big worry there. Getting back to this economic versus Japan, though, we think that there's been very weak economic data. We've had a situation where the number of economic indicators coming in weaker than expected over the last several weeks is at a pace that we haven't seen any point in the last 10 years except in the aftermath of the financial crisis. So the market is very worried about the economy, and in our view, we think it's over-worried about the economy.
Over-worried. So if you were to call the S&P 500's finish from here, where would it be, Paul?
I think going forward, we were at the start of the year, we were thinking about a 1350 target on the S&P 500, and that's where we are pretty much now. We're not looking for rip-roaring gains here, but we think that there's a very strong bunker mentality of investors to sell at the slightest hint of trouble.
We closed, yesterday at 1304. Corporate profits, it's been spotty, but for a lot of technology companies, they've actually exceeded expectations. A lot of people pointing to corporate America's strength. There's cash on the balance sheet. Productivity gains seem to be moving along at a steady pace. Is this the bright spot that you think will keep the equity market from falling further?
Well, earnings have been a bright spot if you look at the S&P 500. But if you look at a broader look at earnings so far this earnings season, if you go into the mid caps and small caps, the beat rate of earnings is not nearly as strong. You go from about close to 80% or 78%. They were just saying earlier, it's the beat rate for the S&P 500. When you go down into the small caps, you're looking in the 60% range. So it's not nearly as robust.
And
but
I guess
still,
also worth pointing out, maybe some of the comparisons were a little weak to begin with.
Well, expectations were low heading into here, so that's why you have such a strong beat on the in the S&P 500. But overall, there's a lot of indecision and companies using the debt ceiling as an excuse, and we're seeing guidance levels. The percentage of companies not issuing guidance this quarter is on pace to be the highest in the last 10 years. So companies don't want to go out there and give us any view of what's going forward.
Paul, thanks so much. Paul Hickey, co-founder of Bespoke Investment Group, joining us there, saying 1350 is the right level for the S&P 500. Keep in mind, we closed at 1304 yesterday.